Hello, hi everyone. A very good morning to all of you. I hope all of you are doing fine. Hi Ignatius, hi Ankush, hello Vihit, Aradhya. How are all of you doing today? So, guys, we're just going to wait for maybe 2-3 minutes for some more people to join in, and then we're going to start the class. Looking forward to it. Just everyone, can you just confirm if you can hear me, if you can see me? Anyone? Ignatius, Sankush, anyone else? If you could just confirm if I'm visible, if I'm audible. Hi, Abhishek. Good morning. Good morning, guys. Okay. Thank you, Rohan. Thank you so much. Yes. Okay. So we are just going to wait for maybe 3-4 minutes and then we will start. We're just waiting for some more people to join in. Hi, Tejas. Good morning. Okay, great. Thank you, Ignatius. Thank you so much. Okay. Hi, Pratmesh, Vijay. Hello, Narsimhan sir. Welcome back. Good morning. How are you today? Very, very, very good to see all of you. Hello, Pradeep. Hi, good morning. Keep the comments going, guys. I would love to see who all have joined. Hi, Dhruv. Hi, good morning. Pratmesh, Pradeep. Okay. Hello, Mohammed. Hello, Sachin. Hi, Nimai Chandradas. Yes, that's your name. Okay. Devram, good morning. Hi, Rajiv. Good to know, Narasimhan sir. Always glad to have you in my sessions. I truly look forward to having you in my sessions because I know you attend all my sessions. Thank you so much for joining. Hi, Shivam. Good morning. Hi, Kiran, Soumyadeep, Alpesh, Vikramjeet. Thank you so much, guys, for joining. We're just going to wait for another minute or two. Yes. Yes, same here, Soumyadeep. Thank you so much for joining today. Okay, so I already have questions coming in. Okay. Hi, Dev. Hello. Okay. Welcome, Narsimhan sir. Welcome. Okay. Hi, Dhruv. What criteria we have to see while investing in the Indian share market? So, Dhruv, we have done a lot of masterclass on equity stocks and in terms of how you can go about investing in stocks. So, you can just go back to my previous videos and you'll be able to get a very good view in terms of how you can go about selecting. I'm doing good, Ignatius. Thank you so much. Abhishek Agarwal. Okay. So, guys, just a quick question. How many of you are joining my session for the first time? Can you just give me a yes? So, Soumyadeep, you guys are already asking me questions about debt funds, which is good to know. That means all of you are looking forward to the session. So, yes, we're going to talk about all the debt funds. So, yes, Soumyadeep, Guild Fund is a debt fund, is one of the debt funds. Yes. Yes. How many of you are attending my session for the first time? Can anyone, if there's anyone who's the first time viewer of my masterclass, just put a yes on the comments. Oh, I think all of you have attended my sessions in the past then. Okay, so Dhruv is attending for the first time. Okay. Yes, Soumyadeep. So don't worry, Soumyadeep. All your sessions related to debt funds are going to be clarified today. Okay. So I have Shubha Brata who's joining for the first time. Okay. Ignatius, fourth session. Thank you so much for coming back. Rakesh Mukund. Okay. Regularly attending Rajiv. Thank you so much. Pradeep, first time. Okay. Good. Yes, Dhruv is the first time. Okay. Good. Just another minute, guys, and we'll start. Okay, Nayan, Alpesh, Sujan, all of you are first timers. Very nice. Okay, Amit, all right. Okay. So yes, so thank you so much for joining in, guys, and I welcome all of you to my masterclass. So let me quickly introduce myself, and for all of you who are attending for the first time, my name is Namrata, and we've been working with Groww for for quite some time, almost 4 years now, and we create a lot of content for Groww. We do a lot of sessions, and this particular masterclass that we started, the intention was to pick a topic and talk in detail about it, so that if someone is attending this class, they should be able to get a detailed overview on that particular topic. So today's topic is debt funds. We started doing the masterclass, I think about 6, 7 months back, last in the month of June, July, and we've done multiple topics related to equity markets, related to mutual funds, in terms of categories, styles, types, everything, right? So today we thought let's do something little different. We've spoken so much about equity. We have done so many sessions speaking about equity, but debt is another important aspect which people should be looking at, right? Debt is an important part of our portfolio as well. We speak so much about diversification, so debt becomes a very important diversification parameter for us. And I think debt funds are something which is a very untouched, topic. A lot of people don't really invest in debt. So, what I believe is when it comes to equity, for example, people invest in equity, they know about it, they read about it. We learn about different companies, we talk about different shares, but then debt is something that a lot of people are confused about, right? So there are a lot of people who really don't know how debt funds work, what debt funds are, and there's a lot of confusion around it. So we thought let's do a class on debt funds today and understand how exactly debt funds work, what they are, and all the doubts that you have related to debt funds. I will try my level best to clarify all the doubts for you. Okay. So today we are going to have a very detailed discussion on debt funds. So keep the questions going, and I'll take your questions towards the end of the session. So I'm just going to quickly start off by sharing my presentation. Yes, I'm guessing it's visible to all of you. Okay, great. So let's understand what exactly are debt funds. But then, I can't just jump into debt funds because to understand what are debt funds, you need to understand certain other things as well. So you need to understand what are debt instruments, what is debt market. So you need to understand all these parameters before you understand what exactly are debt funds, right? So let me ask all of you a very simple question, and I would like all of you to give me the answer on the chat. Tell me what's the difference between debt and equity. Also, from your perspective, what is debt? Just tell me what is debt from your perspective. Anyone, can you just give me the answer on the comments? Let me see how many of you know what is debt in very simple terms based on your understanding of debt. Anyone? Any answers, guys? So what is debt from your perspective? Can I get some answers? I have quite a few of you on the call today. Anyone? Okay, so debt is a loan, borrow, leverage. Yes, okay, absolutely right. So, what is equity? Equity is nothing but owner's capital, right? So, basically, you have people who own a particular business, and if you are an equity investor in a particular business, then you are taking home the profits, which is left out after you pay up the expenses and interest and all of that, right? So, whatever is the leftover profit, the equity shareholders use that or divide that. They take home the profit. Debt is nothing but a loan, right? So in which you generally have an entity that borrows, and you have a bank or financial institutions or individuals that lend the money, right? So you have borrowers and you have lenders when it comes to debt. I'm sure all of you agree to that. The borrower gives back the loan. So whoever has borrowed the money, they have to give back the loan. So basically they have to give back the principal amount along with the interest over a period of time. Yeah. So it's a very simple definition of debt, that in terms of equity, there is a shareholding, there is a profit split between all the or among all the shareholders. In debt, it is just a simple loan. So a business or an individual is borrowing loan from someone and is repaying that loan back along with the interest over a period of time which is defined between the two parties. Now, because the profits of a company are not defined, right, or they're not certain, we believe that equity is risky. When it comes to interest, or when it comes to debt, or when it comes to a loan, the interest is predefined. When you're taking a loan, you exactly know how much interest you're going to pay to the lender. So, what happens is that in debt, a lot of people believe that since interest is predefined, there is no risk in debt. Well, that is not the case, which we are going to understand as we progress further. Okay. So, the most common form of, what the most common form of debt is, what's the most common form of debt, guys? The most common form of debt is a fixed deposit. Yes, I'm sure all of you agree. All of us know about FDs. Most of us invest in FDs. We say that, okay, if I've invested so much in equity, let me have a little allocation to fixed deposits as well. So bank deposits are the most common form of debt that we see. Here, the depositor, Who's the depositor? The bank account holder. So if I'm an individual who is taking a fixed deposit, I'm giving loan to the bank, which means I'm the lender. So if I'm taking a fixed deposit in a particular bank, then I become the lender. I'm giving loan to the bank, and the bank is the borrower who's giving me interest at the end of the tenure, right? So why do we invest in fixed deposit? We get a particular interest from the bank. So bank is the borrower in this case who's giving me an interest, and I'm the lender to the bank. Well, it is not just the banks who take the loans. I'm sure you agree. So in case of FD, bank is taking the loan, but you also have other borrowers in the market. Who are those other borrowers? So those other borrowers could be, say, government. So state government, central government, they are taking loans. They could be companies who are taking loans. They could be NBFCs, non-banking finance companies who are taking loans, right? So these are the different borrowers in the market, or different individuals, entities who are taking loans in the market. I hope it is clear. So in debt, I'm going to go a little slow because I want all of you to understand the concept, because it's a very important concept for all of us to understand. Now, when you hear the word debt instruments, right? So what are these debt instruments that we are talking about? It is nothing but an instrument which is issued by the borrower. So whoever is the borrower, who is borrowing money, right? What are the instruments which are issued by the borrower as an acknowledgement of the loan? So basically, if a bank or if a company is coming up with bonds, so company is the borrower, it is issuing bonds in the market, and we as investors are buying those bonds, right? So the borrower, which is a company, is issuing a particular debt instrument. Okay. So if that's the case, then let's understand what is the difference between a bank deposit and a debt instrument. So what is the difference between a fixed deposit and any other debt instrument that we have? What's the difference? So in case of deposits, you will understand that if you want to withdraw the money, you can withdraw anytime. All you have to do is go to the bank and tell them that I want to prematurely withdraw my money. And what are they going to do? The bank, so it is, it is possible the bank is going to give you your money back along with the interest for that holding period that you have stayed invested in that particular fixed deposit. But when it comes to debt instruments, which are nothing but bonds, premature withdrawal is not possible. So you cannot prematurely withdraw from a particular bond. So what happens is, just like equity shares, your bonds and your debt securities are traded on the secondary market. So like how shares are traded on the secondary market, which is nothing but your NSE and BSE, similarly, even bonds are traded on the secondary market. And then you can trade your debt securities there. Is that okay? So you can trade your debt securities in the secondary market if you want to sell it, but it's not a very easy process because you have to find a buyer, right? And finding a buyer is not an easy process. Clear? So I hope so far it is understood. So now if we are looking at these debt securities, which is nothing but the loans which are borrowed by different entities, they can either be long term or they can be short term, right? Yeah. So bond is nothing but a security. Clear? So these bonds can be both short term and they can be long term, right? So when we say debt market is categorized into short term and into long term securities, or short term market and long term. So let's understand what are the different types of debt instruments which are available. So like how Amit is asking, so what is bond? It's basically a debt instrument. Well, let's understand what are the different types of debt instruments which are available. Okay. So debt instruments can be categorized into short-term debt instruments and long-term debt instruments. And I just said that, right? So let's understand which are these short-term debt instruments and which are the long-term debt instruments. So first, when we're looking at short-term debt instruments, so basically short-term debt instruments are any instrument where the tenor is less than 1 year. Okay, so which means the maturity, average maturity of the bond is less than 1 year, is a short-term instrument. Now, what are some examples of short-term debt instruments? So you have treasury bills, which are T-bills. Then you have certificate of deposits. You have commercial papers, and then you have TREPS, which is tri-party repo. Now, I'm going to explain each of them before we move on to long-term debt instruments. So let's start with what are treasury bills. Okay. So treasury bills are basically, think of treasury bills as bonds which are issued by the government. Okay. So treasury bills are issued by the government. In this case, since the loan is borrowed by the government, T-bills are considered to be the safest. Hence, they offer the lowest interest rate, which is possible in the short-term category. Okay. Now, treasury bills come with different maturities. You could have a 91-day T-bill, you could have a 182-day T-bill, or you could have a 362 days T-bill. Okay. So, treasury bills are issued by the government, and they are short-term debt instruments, and they're considered to be the safest. Next, you have certificate of deposit. So, certificates of deposits, or we call them CDs, they are issued by the banks. Okay, so banks, so if bank wants to borrow money from the market, they will issue CDs or certificates of deposit, and they are relatively riskier compared to treasury bills because government is considered to be the safest. Next is banks, so they're considered to be a little more risky compared to say T-bills, because T-bills are issued by the government, and hence certificate of deposit offer slightly higher interest rate compared to treasury bills. Okay, as the risk goes up, obviously the interest offered also will be higher. Yeah. Next, we have commercial papers. So, what are these commercial papers? So, commercial papers, or CPs as we call them, are nothing but bonds which are issued by companies. Okay. In India, mostly these commercial papers are issued by NBFCs, which is non-banking finance companies. Most of the commercial papers are issued by NBFCs, and they're considered the riskiest in the short-term category. So, if you look at the short-term category, they offer the highest interest rate because they're considered to be the riskiest. So, they're definitely more risky compared to a certificate of deposit which is issued by bank and a treasury bill which is issued by the government. Clear? I hope it is clear. So basically, when we're looking at debt funds, the objective of a debt fund is to optimize the returns. Hence, a short-term debt fund would invest in a combination of CDs and CPs. So short-term debt funds would invest in short-term debt papers. And similarly, long-term debt funds would invest in long-term debt papers that we are going to discuss. Next, you have TREPs, which are nothing but tri-party repos. So what exactly are these tri-party repos? So tri-party repo are basically overnight or one-day loans which are borrowed by banks, and they're generally lent by mutual fund companies. Okay. So in case of TREP, so when there's overnight lending happening, so if suppose someone wants to borrow money just for one night, that is done through this particular debt instrument, which we call as TREPs, tri-party repos. Okay. Government security is always given as a collateral when a TREP transaction is happening, or when an overnight loan is given. And TREPs are again considered to be very safe in this particular category. So as the tenor is shorter, the safety aspect is higher. So if you look at overnight funds, so in debt funds, we have a category of funds called overnight funds. These overnight funds, they invest in TREPs. Okay, because they are only used for one-day parking of funds, or say up to 7 days parking of funds, which we'll talk about. Okay. Next, we have long-term debt instruments. So we spoke about short-term debt instruments. So these are instruments in which the average maturity of that particular debt instrument is less than 1 year. Long-term debt instruments is when the average maturity is more than 1 year, right? Simple. So let's understand what are the different types of long-term debt instruments which are available. So first you have government bonds, right? So we also call them GSEC, we call them gilt, and so on. So these are basically government bonds. So they are basically, government is the borrower. They are borrowing money by issuing these government bonds. And a 10-year government bond, if you look at, is called the benchmark bond. A 10-year government bond, we call it a 10-year GSEC or a 10-year gilt, is considered to be a benchmark bond, and it is the most famous in the category. A lot of people know about it. So for example, Amit or I don't know, one of you were asking about gilt funds. So gilt fund would invest in government bonds or would invest in gilt securities. Yeah. So like I said, a gilt fund would invest in government securities. Yeah. Next long-term debt instrument is a corporate bond. So you also have corporate bonds. So we also so corporate bonds are nothing but bonds. So a corporate bond fund would basically invest in corporate bonds. So corporate bonds are issued by companies. So then you have long-term debt funds. So you have corporate bond funds which invest in corporate bonds. Then you have long-term debt funds which would invest in a combination of GSEC and corporate bonds with longer maturity. Okay. So in the long-term debt instruments category, we have government bonds, government securities as we call them, and then we have corporate bonds. And these bonds again, so like the corporate bonds are issued in the range of 2 to 10 years. So generally they come in the 2 to 10 year kind of a time horizon or average maturity. Okay. Mutual funds definitely have contributed largely in the development and the growth of the corporate bond market. So I hope it was clear. So just to summarize, we have short-term debt instruments, which are your treasury bills, certificate of deposits, commercial papers, and TREPs. And in your long-term securities, you have your gilt or GSEC or government bonds, as we call them, and then you have corporate bonds. Short-term instruments, the average maturity is less than 1 year. Long-term instruments, the average maturity is more than 1 year. Clear? Okay. So now let's understand what exactly are debt funds. So if we have understood what are debt instruments. Okay, before we move on to debt funds, let me tell you what exactly is a debt market. Okay. So since now we've looked at the debt instruments, obviously it is very important that we understand debt market as well. So unlike equity markets, right, debt markets are honestly not that famous in India. Debt markets in India is mostly dominated by institutional investors. Retail investors don't really look at debt markets in a big way. So if you look at a scenario, right? If you look at an IPO or an FPO, I'm sure all of you know what is an IPO or initial public offering. FPOs follow on public offering. It's a big corporate activity. So when a company is coming out with an IPO or an FPO, it's not a regular event. It's a one-off event, right? It's a really big activity for any company, and this happens very very occasionally. Doesn't happen regularly. At the same time, when the same company is borrowing loans by issuing bonds, so if a company is issuing bonds, that's a very very regular activity for them. It's not such a big deal. Okay, it's a very regular activity to issue bonds. For example, if you look at RBI issues treasury bills on a weekly basis. Okay, so every Wednesday you'll have an RBI treasury bill that is issued. Okay, now during the issuance of any debt instruments in the primary market, okay, mostly the financial institutions like banks, mutual funds, insurance companies, pension funds, they end up buying these debt instruments. Retail participation is very limited. Okay, so whenever these bonds or debt securities are issued by companies, most of the borrowers in that case, most of the people who are going to be a part of that subscription is going to be your banks, MFs, insurance companies, PF funds, and so on. Retail investors generally very limited. So, like in equity, if you invested in a public offering and subsequently you want to sell your shares, go to the secondary market. Similarly, even in debt instruments, like I said, they're listed and traded on the secondary markets. So all the debt instruments also they follow the same logic. Yeah. So this is the debt market. So we learned about short-term debt instruments, long-term debt instruments. We learned about the debt market. Now we are going to learn about debt funds. So if you are looking as an investor, you want to invest in debt funds, then what are debt funds? So basically, debt funds are basically those funds that invest in debt securities. Okay, so what are equity funds? They invest in equities, right? They invest in stocks. Debt funds invest in debt securities, and the different categories of debt funds based on the type of debt instrument they are investing in. Yeah. So I'm going to quickly explain different types of debt funds that are available and how you as an investor can make use of debt funds and get that slightly extra return compared to a FD or a savings account and optimize your portfolio. Okay. So we're going to spend the next half an hour discussing about debt funds, and I can assure you that after this half an hour that we're going to discuss this, you will have complete clarity about debt funds. Okay. So like I said, debt instruments are clear. Funds that invest in debt instruments are your debt funds. So what are some of the categories? So, in equity, for example, we have different categories. So in equity funds, we have categories like your large caps, mid caps, flexi caps, sectoral funds, thematic funds, and so on. Similarly, you also have categories in debt funds, which we're going to talk about. So if I just give you a brief overview, and don't get worried, I'm going to explain it all. So we have overnight funds and liquid funds, ultra short duration funds, low duration funds, and money market funds. Then you have short duration funds and medium duration funds, dynamic bond funds, floating rate funds, banking PSU funds, corporate bond funds, credit risk funds, gilt funds, and gilt funds for 10-year constant maturity. Now, the reason I'm naming all these funds for you is just to psych you out a little bit, but don't worry, it's super easy. I'm going to explain. I'm not going to explain everything. I'm just going to explain the logic behind each of these funds. Okay. So, what are some of the questions that are running in your mind? So, things like, which is the best fund to invest in? I'm sure all of you want to know which is the best debt fund I should invest in. How to select the right debt fund? I'm sure you guys want to know, how do I select the right debt fund for me? Are all debt funds safe? Now, that's a question that I want to answer for all of you. And is there any risk involved? Okay. So, let's understand all of this. So if we look at an overnight fund, right? So I'm sure, like I spoke about, what do overnight fund invest in? They invest in trips, right? So if we look at an overnight fund, the regular requirement is that overnight funds should invest their money only in those papers that have 1 day maturity. Okay, that's a very simple logic, that any paper or any debt instrument which has a 1 day maturity is where these overnight funds should be investing the money, because the money is invested for overnight purpose. And the debt instrument which fits that bill is TREPs, tri-party repos, right? Now, because of this, we can consider overnight funds which carry the least possible risk and reasonable returns, and they are best for those investors who are looking to invest for 1 to 7 days. So, if your time horizon for a particular investment is 1 to 7 days, then you could look at overnight funds. Now, you as retail investors might be wondering, why will I invest for 1 to 7 days? But if you look at a lot of companies who want to park their money, so they probably have a lot of funds in their account and they don't want to keep it in their account, because current account you get no interest. So you might as well park that money in an overnight fund, and you can withdraw it within 7 days and use it for your other activities. You will get decent return, right? And they are probably investing a few crores. It just makes sense to invest in an overnight fund, right? Similarly, if you look at liquid funds, they invest in debt instruments like, say, treasury bills, commercial paper, certificate of deposits, corporate bonds, etc. So they invest in these securities. The only condition is that the leftover maturity of that particular paper should be less than 91 days. Okay. If the leftover maturity of a particular debt instrument is, say, less than 91 days, then that would be used in a particular liquid fund. So in liquid fund, the leftover maturity of the paper is less than 91 days. Now, it is ideal for those investors who are looking to invest for 7 days to about 3 months. So if your time horizon is 7 days to 3 months, then liquid funds are a decent category to invest in. Even these funds are relatively safe, but slightly riskier compared to overnight funds, obviously. So similarly, if you look at, say, banking and PSU funds, right? So I'm just giving you an overview that when you look at, say, banking and PSU funds would invest in debt instruments which are issued by banks and public sector entities. If you look at floating rate funds, they would invest in floating rate bonds where the interest rates keep changing along with the market rate. Now, if the rates in the market go up, right? That means I'm saying rates in the market, I'm talking about the interest rate. So if the interest rate goes up, the interest rate offered by the floating rate bond would also go up along with the market, and the reverse is also true. So investors would ideally not be affected in that particular case. Then you look at corporate bond funds. So a corporate bond fund would invest in companies or bonds which are issued by companies but with a better credit rating. That is very important. So corporate bond funds invest in bonds of companies which have good credit rating. And then you have credit risk funds which are investing in bonds of companies again, but with not great credit rating. So credit rating could be on the slightly lower side when you're looking at a credit risk fund. So obviously, if the rating is lower, the interest offered is going to be higher. Now, gilt funds, as the name suggests, is basically are only those funds which are investing in government securities, or basically bonds or securities issued by the government. Clear? So I'm sure it still doesn't answer your question, how to select the funds and what are the risks involved in debt funds. So I really want all of you to understand there are two types of risks which are associated with the debt funds that we should understand. Please understand that all debt funds are not risk free. So a lot of us believe that equity is risky, debt is not risky. That is not true. There are risks associated with debt funds as well that we should understand. So first is the credit risk or default risk, and second is the interest rate risk. So I'm going to talk about both of them. Let's start with credit risk. So what exactly is credit risk? So I'm sure if you can understand that when the word credit risk is used, it is basically the risk of default. So companies, even if they're issuing bonds, they can default, right? I mean, there's no harm. I'm sure it's possible that they don't have the money to repay the lenders, right? Or the investors. So what if the borrower doesn't return the money? So if it's a corporate bond, for example, if it's a company and they are not giving back the money to the investors, then that's a risk of default. So even if the payment is delayed, by the way, it is called as default. So how do we measure the credit worthiness of a company, right? So if we are investing in a particular fund and we're looking at the debt securities of that particular fund, then how do we know how good is that particular company? How do we identify the credit worthiness of that company? So for example, as individuals, we have something called as a CIBIL score, right? I'm sure all of you know that. So CIBIL score tells the credit worthiness of an individual. Based on the CIBIL score, you get your loans. If your CIBIL score is good, then you're eligible for loan. If your CIBIL score is low, the companies are not going to give you any loan, correct? So basically, CIBIL score is a credit worthiness of an individual. Similarly, the credit worthiness of a company is determined by credit rating. So every company gets a credit rating, and so you have multiple credit rating agencies who give a credit rating to a particular company. So based on that credit rating, you get the credit worthiness of that particular company. So if you look at this, for example, all these that you see, so these are your S&P and Moody's ratings. So if you have triple A, double A plus, double A minus, all these are the credit ratings of a particular company or an institution. So what is the credit rating that's given for government bonds? Can anyone tell me? So just use your chat option comments and tell me what is the credit rating of government bonds? Can anyone tell me? What is the credit rating of government bonds? Anyone? Give me the answer. For a government bond, what do you think is the credit rating? So like we have triple A, double A plus, double A minus, and so on, right? What do you think is the credit rating of a government bond? Waiting for answers, guys. Okay, triple A is what Rohan is saying. Okay, anyone else? Any other answers? Okay, so let me tell you that government securities are not rated. There is no rating given to government securities. Okay, so I know all of you are saying AAA plus, double AAA and all of that. So government securities are not rated. There is no credit or default risk in government securities. There is no credit risk because if you are lending money to the government, just remember government has the superpower to print currency or to increase the taxes. So government has the provision to get money from somewhere and pay up the investors. So which is why it is assumed that government is never going to default. And if we are assuming that the government is never going to default, they are not given a credit rating. Okay. So which is why governments, we call it sovereign rating. So government bonds are also called sovereign bonds, and they're given something called as a sovereign rating. Clear? So which is why, so just remember government bonds are never rated. They are not given any rating. Now, if you look at AAA and all of that, right? Yeah. So if you look at say AAA rated companies, they would carry least credit risk. So now companies are given these kind of ratings, okay? And a AAA rated company would have the least amount of risk associated with it. But obviously, since the risk is the lowest, even the interest that they are offering is going to be on the lower side, right? So as the credit rating starts reducing, so from AAA it becomes AA plus AA. As the credit rating keeps reducing, the risk associated with that bond increases, right? I'm sure you agree. As the rating keeps reducing, the risk keeps increasing. High risk is compensated with higher return or higher yield. Yes? So yes, so you're right. So Amit, you're right. Gilt funds, which are basically, so government securities are not rated. Okay? So now if you're looking at higher risk, because as the rating keeps going down, the risk increases. So if the risk increases, the return or the yield is going to increase. So as the credit rating starts going down, the interest rates offered by the bond starts going up. As the risk reduces, the interest keeps increasing. So if you see a bond with higher yield, if you look at any bond and that has a very high yield or a higher yield, it means that the credit rating is on the lower side. Now I'm going to ask you guys another question and I would like all of you to answer. So I'm sure you guys see this on your screen. Okay, so let me just expand it for all of you. So basically, I've given you example of two funds. So there's fund 1 and there's ultra short term fund 2. Okay. So as you can see in fund 1, the triple A rated is almost 46% and there's 24% which is double A. Okay, and you can just see that. And if you look at ultra short term fund 2, we have sovereign, which is 13.43, triple A rated securities, which is almost 68%, and so on. So now what I want all of you to tell me is that which fund's portfolio should give higher yield, fund 1 or fund 2. So fund 1 has 46% AAA rated and 24% AA rated. Fund 2 has 68% AAA rated. So I want you guys to tell me which fund should give higher yield. Okay. So, okay, great. I'm getting a lot of answers. Okay. So now if I were to give you the answer, just look at this. For fund 1, the YTM, which is yield to maturity, is 4.45%. And for fund 2, the yield to maturity is 4.24%, which means for fund 2, the rating or the yield is slightly lower compared to fund 1. Now, why is it so? Because in fund 2, the risk is on the lower side, because there's sovereign, which is 13%, and then there is AAA, which is 68%. So, which means the risk is slightly lower in the second fund. And that is why the return is also on the lower side. Whereas if you look at fund 1 compared to fund 2, since the risk is on the higher side, the returns are also slightly higher. Okay, I hope that is clear. So when we are looking at credit risk fund, they invest in bonds with lower credit rating. So if you're looking at a credit risk fund, right? So like I was telling you about credit risk funds. So credit risk funds generally invest in those bonds which have a lower rating, so that credit risk funds have the potential to give you slightly better returns compared to other categories or corporate bonds and so on. Okay. Credit risk funds are considered to be slightly more risky, which means they give slightly better returns. Now let's look at. So I hope credit risk was clear to all of you. Now let's understand what is interest rate risk. Okay. So is there a risk on the interest rate? Now that is what we're going to understand. So I think it is very important to understand this. I'm going to spend the next 5 minutes telling you about interest rate risk. So there are instances where people have actually lost money in a debt fund. Okay, there have been instances where there have been losses in the portfolio in the case of debt funds. But people are not able to understand why are these losses happening. So a lot of people question that why are these losses happening if I'm investing in a debt fund? Debt funds are not supposed to give me losses. They're only supposed to give me positive returns. So let's understand, why do certain debt funds give negative returns? And the negative returns in debt funds comes because of the interest rate risk that I'm going to tell you about. So, okay, so let me give you an example. Now, when we're putting money in a fixed deposit, okay, so let's say we're going to hold it till maturity. So imagine a scenario where you have invested 1 lakh rupees in a fixed deposit, and say the interest offered is say 6% after 1 year. So which means after 1 year, if you invested 1 lakh in a fixed deposit, you are going to get 1 lakh 6,000 rupees. And I'm sure that is quite clear. Now, if you want to withdraw that money, all you have to do is approach the bank and apply for a premature withdrawal. They would close the FD and give you the interest based on the number of days that you have held that particular fixed deposit. Simple, right? At the same time, just imagine that you're holding a bond. So you're holding a particular bond, and let's say the face value of that bond is 100 rupees, and it has a 6% coupon. So when you say 6% coupon, think of it like an interest, and the tenor of that bond is say 3 years. Okay. So a simple bond with a face value of 100 rupees, a 6% coupon, and a 3-year tenor. And say you bought that particular bond last month. Now, what happens is, if you need your money back, can you go back to the company and ask for premature withdrawal? You can't. We've discussed that in the past. Premature withdrawal is not possible in the case of debt instruments or debt bonds. Then what should you do? Then you'll go to the secondary market and you'll find a suitable buyer who's willing to buy that particular bond. So let me repeat the scenario for you. You have a bond whose face value is 100 rupees. The coupon is 6% and tenor is 3 years. Now let's say there's a new bond that has come into the market, which is now offering you 7% coupon for the same tenor. So again, the face value is going to be 100, but it's offering you 7%. So you as an investor, if you want to, if I want to sell my 6% wala bond, will you buy it from me? So as an investor, give me a yes or a no and tell me, if I want to sell my 6% bond in the market and there's a 7% bond which is already available, will you buy the 6% bond from me? Give me a yes or a no. Give me a yes or a no. It's a simple logical question. Give me a yes or a no. So if I have a 6% bond, obviously I'm not going to buy, right? Because if I'm getting another bond which is at 7%, then why will I buy a bond for 6% from me? Correct? So which is why, what am I going to do? Because now no one's going to buy my bond, right? I'm going to offer them 100 rupees, 6%. They're not going to buy from me. So what am I going to do? I'll give you a discount. So I will tell you, instead of giving me 100 rupees, you give me 96 rupees. Correct? So instead of giving me 100 rupee, you give me a 96 rupees, then you might consider buying the bond, okay? Because that 100 rupee bond at 7% or a 96 rupee bond at 6%, I think 96 rupee bond at 6% is a better deal, right? So which means now I'm going to offer the same bond at a discounted price to you, okay? That is how you're going to be compensated. Now, if the opposite is also true, if I hold a 6% bond and there's a 5% bond which has come out in the market, then I will charge you a premium. Since you're selling you at 100 rupees, now I'm not going to sell you at 100 rupees, I'll probably sell it to you at 104. I'm going to sell my bond at a premium. So what is the simple conclusion that you draw out of this? Okay. So the simple conclusion that I want all of you to understand is that if interest rates in the market go up, if the interest rates are going up, the market price of existing bond is going to go down, right? So if the interest rate in the market has gone up, then the market price of the existing bond is going to go down. And if the interest rates go down, then the market price of the existing bond will go up. Clear? So interest rate risk is nothing but the market risk which is associated with a particular debt instrument or a debt security. So the price of the debt instruments keeps changing based on the interest rate changes in the market. And when the market price of the bond goes up, if you sell it, you would have earned capital gains. Clear? So if you look at government bonds, for example, the interest rate is a reference point for us. The government bond interest rate is generally the reference point. I hope it's not getting to technical figures. I'm trying to explain in as simple terms as possible because interest rate risk is a very important risk for all of you to understand. So if you look at, the government bonds, do I have that particular chart? Okay. So if you look at government bonds, for example, it keeps changing. So obviously the law of nature says what goes up has to come down. If you see, interest rates are low right now. So for government bonds right now, the interest rates are quite low, but they are on an increasing trend. So which means now as the interest rate starts going up, the bond prices are going to come down. Okay. So one last thumb rule that you should remember, as the tenor of the bond increases, so as the tenor increases, the interest rate risk or market risk also increases. So which means if the average maturity of a particular bond is high, the market risk is also high because the interest rates keep changing. So in a debt instrument, you should look at instruments which have low yield, low maturity, low tenor. Okay, because the lower the tenor, the lower the market risk. It's exact reverse of equities. So in equities, as the time increases, the market risk reduces. But in case of debt funds or debt securities, as time increases the tenor of the debt security increases, the market risk also goes up along with that. Clear? So just to sum up, interest rate risk is the market risk. Okay. As the interest rate starts going up, the bond prices are going to go down, and the reverse is also true. Short-term bonds carry less market risk. Long-term bonds carry high market risk. So effectively speaking, your government bonds, a 10-year government bond actually is a very risky proposition because the interest rate risk is very high. In a government bond, you're not going to have credit risk, but you're definitely going to have interest rate risk. Okay. So now, all of you must be thinking, okay, all this is great. I've told you so much about debt securities, I've told you about risk, I've told you about all of that. How does it matter to me? I want to invest in a debt fund. Tell me about debt funds. How do I build my debt fund portfolio? And that is what I'm going to tell you about. Okay. So when you're looking at selecting funds, obviously for the short term, so there are three scenarios that I'm going to tell you. So your first strategy, your first scenario, if your investment horizon is up to 1 year, so 1 year or below, then what should you do? So if your investment horizon is less than 1 year, then you could look at investing in, say, overnight funds, like I said, liquid funds. Then you have ultra short and low duration funds, money market funds, and you have short duration funds. So let me explain it to you in more clear terms. If you decide which fund, first decide how long you're looking to invest money. So if you're looking to invest in a debt fund, again, you need to know what's your time horizon for a particular debt fund. Say if your time horizon is 3 to 4 months, okay, 3 to 4 months, then you could look at funds whose portfolio average maturity is around 100 to 120 days or 3 to 4 months. So basically, your time horizon, your investment horizon should match the average maturity of the portfolio of that particular debt fund. That is very, very important. So if your time horizon is 3 to 4 months, then the average maturity of the debt fund portfolio also should be, say, 3 to 4 months or 100 to 120 days. So if you look at this example that I've showed you, it's an HDFC money market fund. You see that table on the top. The average maturity of this particular fund is 103 days, as you can see. So the average maturity is 103 days, and the yield to maturity is about 4.05%, which means that you were approximately holding, for say 103 odd days, you can expect about 4% return from this particular fund. If you invest in this fund today and you want to take out your money, say after about 100 days, then you can expect about 4% return. Similarly, if you look at this ICICI Ultra Short Term Fund, right? The portfolio average maturity is about 0.32 years, which is approximately 110 days. And you can expect, say, about 4 to 4.5% return from this fund. So if you invest in this fund for, say, about 110 days, you will get about 4 to 4.5% in this particular fund. Similarly, if you look at this, so which is an ICICI, again, ultra short term fund, um, as you can see, you must be thinking, when we're looking at 4% return. So we are talking about the CAGR, right? If we are seeing the return is, say, about 4%, how good is that particular return? I mean, isn't that on the lower side? So if I'm investing for 3 months, 4% is nothing great. Normally, then what you do is you compare this with the 1 year FD. The problem is that we are comparing a 3 month debt instrument return with a 1 year FD return. But ideally, what should you be doing? You should be comparing the returns for 3 months of a fixed deposit. So if you look at the 3 months FD returns in a particular fixed deposit, the rates are about 3.9%. And you have your debt funds which are giving you about 4 to 4.5%. So don't you think then, compared to a fixed deposit, your debt funds obviously make more sense from a return or YTM point of view. Similarly, if you look at just forget debt fixed deposits, even if you look at savings account is giving you about 2.93%, whereas your present overnight funds are giving you about 3.5 to 3.7%. So, which is why, if you look at short term, which is if your time horizon is less than 1 year, you have categories of debt funds which have the potential to give you returns which are better than fixed deposits. But when you're doing a comparison, you should do an apple to apple comparison. A 3 month debt fund return with a 3 month FD return. You can't do a 3 month debt fund return with a 1 year FD return. That is not the right comparison. Okay. Now, the second strategy is if your time horizon is between 1 to 3 years. So less than 1 year, we've discussed, right? If your time horizon is, say, 1 to 3 years, then what is it that you should be looking at? So if your time horizon is, say, less than 3 years, then what should you, okay, oh, by the way, in the previous strategy also, what are the parameters that you should look at while you're investing in a debt fund? You could look at the lower expense ratios, higher AUM, and good portfolio credit quality. Okay, so whenever you're selecting a debt fund, you look at low expense ratios, high AUM, which is assets under management, the total AUM of the fund, and portfolio credit quality. Now, second one, if your investment horizon is between 1 to 3 years, then what should you look at? So for this particular category, you could look at funds like short duration funds, floating rate funds, and corporate bond funds. Okay. So obviously, when you are selecting, when you're looking at, going through your or selecting a debt fund, you can come back to this video and look at what I'm telling you. So if adequate time is given, debt funds have the potential to beat your fixed deposit returns. So I'm just going to maximize the screen for it to be a little more visible. So as you can see, you have your Access Corporate Debt Fund, ABSL Corporate Bond Funds, HDFC. I've given you all these examples. The 2-year returns and the 3-year returns, as you can see, are definitely higher than fixed deposit returns. Correct? So which is why it is advisable that for even 1 to 3 years, your debt funds are giving you decent returns. A small exposure towards credit risk fund would also be good. So I truly believe that credit risk fund, a small exposure is always good because they tend to perform well, especially in current scenario where interest rates of other bonds are on the lower side. Okay. Now the last strategy is taking advantage of the fall in interest rates, or basically investing in markets like these where the interest rates are falling. Then what should you do? So investing in these funds, so basically if you're investing for so then you look at, say, long duration funds, you look at gilt funds. So gilt funds, long duration funds are the category of funds that you can look at in times like these where the interest rates are falling. Okay. Why should you do that? Because when interest rates are high, they're expected to go down, and there's a downward trajectory that you are seeing. This is a time when you can expect double digit returns from your debt fund. So when you're looking at double digit returns from equity funds, even your debt funds have the potential to give you their double digit returns if you are investing in a scenario where the interest rates are falling. Okay. And you're investing in funds like your corporate bond funds or your long duration funds or your gilt funds. In 2020, to support the economy during COVID, the interest rates were cut. During this time, what would have happened to funds with long term bonds in the portfolio? So during this time, what had happened was that because if you had invested in a gilt fund, you would have got a double digit return. As of October 2020, 1 year return was almost 13% in gilt funds. Equity like return from a debt fund. So this kind of return is only possible with long term bonds when interest rates start going down. Okay. Now, I agree that these are three different strategies which might be slightly confusing for you, but all you have to understand is very simple. Depending on your time horizon, you invest in a particular debt fund, and depending on your time horizon, the average maturity of the debt fund portfolio should match your investment horizon. That is very, very important. Okay. So, if you're looking at investing for less than 1 year, then that means you have a short term horizon. So, you look at overnight funds, liquid funds, ultra short duration funds, low duration funds, and money market funds. If your time horizon is 1 to 3 years, then you look at floating rate funds, banking PSU funds, short duration funds, and corporate bond funds. And in markets where the interest rates are falling, then you could definitely look at gilt funds and long duration funds because they could have the potential to give you high returns as high as a double digit return. And like I said, debt funds definitely provide you the opportunity to really beat your fixed deposit returns. And since debt instruments are generally not available to retail investors, as retail investors, you can invest in debt funds because they are investing in debt instruments. So we can't invest directly in debt instruments. I can't buy a CD or a CP or a treasury bill, anything directly, but I can invest in these debt instruments through debt funds, which is a great alternative. And obviously, it has the potential to give me returns which are slightly better than fixed deposits. So great. So yeah, so with that, I would like to end my session. And yes, so open to questions now. I'm sure a lot of you have many questions. So please feel free to ask your questions, and I'll be more than happy to answer the questions for you. Okay. Uh, Yeah. So, can we say gilt funds have no rating? So, it's not gilt funds. Like I said, the government securities are not rated, right? So, it's always the securities that we look at the rating for. So, the government securities are not rated. They carry a sovereign rating, as I said, which means the default risk is zero. So, you will get your payments on time if you've invested in a particular gilt fund. Okay. What are the other questions? Thank you so much, Ignatius. Okay. What are the other questions? So, if you are, guys, if you're going to ask me specifically about any particular fund, I will not be able to answer that. So, please ask me generic concept related questions. We'll be more than happy to answer it. And also, just one more thing. I've taken names of certain funds in my presentation. Please don't take that as a recommendation or an advice. I really just use those examples for academic purpose just to explain the concept to you. Okay. Okay. What are the other? Yes. So, should you check the expense ratio while choosing any debt funds? Absolutely. So, like I said, you look at the expense ratio of the debt fund, you look at the AUM, and then you look at the credit rating of the securities. These are the three parameters you should consider once you have decided which category of debt fund you want to invest in. So, if you've decided the category of debt fund, then you look at the expense ratio, you look at the AUM, you look at the credit rating, and based on that, you could pick your fund. Okay. Okay. What are the other questions? Do we get interest credited to our bank account periodically, monthly? Okay. So, Mohammed, when you're investing in a debt fund, right, the interest keeps getting accumulated, right? So, when you're investing in a fixed deposit and say it's an annual FD, for example, then the interest gets accumulated. And when you withdraw the FD, you get the interest. Similarly, in mutual funds, when you do a withdrawal, that time you get the interest. Okay. Okay. So, any other questions? So, I know that just a minute. Let me just stop the screen sharing. Just a minute. So, some of you are asking me taxation in debt funds. So, when we're looking at debt funds, right? So, again, we have short-term capital gains and we have long-term capital gains. So, short-term capital gains are basically if your holding period is less than 3 years, and if your holding period is more than 3 years, we call it long-term in case of debt funds. So, in equity, for example, it is different. In equity, it is 1 year short-term, and more than 1 year, it is long-term. In case of debt, it is 3 years, up to 3 years is short term, and more than 3 years is long term. So, now what is the taxation that you have to pay? So, if you fall in a particular tax bracket, so then what happens is that in short term, so if your tax rate is 30%, then short term capital gains on debt fund is going to be 30%. So, basically, whatever is the tax bracket that you fall in, that is the amount of tax that you're going to pay in the case of short term. In the case of long-term capital gains, which means if your holding period is more than 3 years, then we look at 20% is the taxation along with indexation. So what is indexation? So indexation is basically like a chart which is designed and that takes inflation into account. So inflation adjusted return. So it is 20% after indexation. So effectively it comes to be less than 20% only. So which is why it is advisable. I mean, just so generally they say that, in debt funds, if your taxation, short term it is as per your tax slab, long term it is 20% with indexation. I hope the tax part was clear for all of you in terms of indexation, taxation. Okay, debt mutual funds, do we get into? Yeah, so I think I have already answered that question for you. If you choose the growth option, for example, then obviously it'll keep getting accumulated. And otherwise, you can also periodically withdraw using SWPs, right? So we have SWP, you can periodically withdraw your returns from that. So taxation question is taken care of. Okay. So I guess if there are no more questions, I think we'll end the session. And I'm going to do the same session again in Hindi at 12:30. So if any of you want to, join that session, feel free to join. So thank you so much, everyone, and I wish you all the best for your investments. And I truly, truly hope the debt fund topic was, understood by all of you. So thank you so much. Bye bye.